Welcome to the Legacy Lounge. Today is a very special day. We welcome Samir Sinha as our new Chief Investment Officer at Stavis Wealth. Welcome, Samir.
Oh, it's such a pleasure to be here, Deborah. Thanks for having me here.
In the time we've been working together, it's really been enjoyable, and you've had such a variety of investing, both investing with individuals, and for institutions. How has that created your approach to investment management and working with clients?
So the approach to both actually might surprise many people is similar because the goals are often the same if you're saving for a children's education or if you are trying to fund an endowment. Your goals are the same, but the approach might be different in the sense of the tools that you use. And over the years, the tools have actually widened. And so you have a broader set of investment options, whether you're an individual or an institution. So I like to say now, whatever type of investor you are, you really have a lot of different ways to create what many would historically say is an institutional quality portfolio. So really an individual or an institution can achieve similar goals, but in slightly different ways depending on your liquidity needs or sort of long-term objectives.
And you've been able to adapt to both.
That's right, and I think
Excellent.
that's what's wonderful about what's happened over the last 20 years in the investment management industry is that we really have embraced trying to create more options for investors. And the question is, how do you use those tools and how do you use them most effectively?
So if we can spend some time talking about life lessons. You started at a true value shop. What are the takeaways from there?
Yeah, so it really is. I've been very fortunate in my career and very fortunate in my life actually to have gotten such a different perspectives from different places that I've been. And starting with Sanford Bernstein, as you said, a true value shop, really focused on deep in research into the individual companies or individual sectors or the macroeconomy. And so really having that approach to investment management of digging deeper than the average investor and really understanding what drives a company, what drives asset allocation, and I particularly was covering chemicals, which, as you can imagine, my background was chemical engineering, so I had a good understanding of the industry, but then had to apply, how do you apply this to investment management, and how do you apply to, should I buy this stock or should I consider not buying this or holding it or selling it? And so that was a really eye-opening experience for me, and I was around just an incredible group of people who were all covering different sectors. So I had this opportunity to absorb so many different lessons from each of them of how did you look at media or how did you look at technology. And so in the late 90s, if you remember, Sanford Bernstein was a value shop and everybody was buying technology at the time. But Sanford Bernstein itself was owning a lot of the chemical sector because those were inexpensive, they were value stocks. And so we actually really had a really crucial role within the firm. And so I think that really gave me a really great opportunity to sort of sharpen my skills as an analyst.
Really serving on the front lines, identifying specific stocks that clients should really consider holding or selling.
That's right.
Great.
And you really get an understanding of how Sanford Bernstein operated versus other companies. And it was different. So I was learning something that I think was differentiated from some of my peers, where many of them were connected to investment banks at the time. Sanford Bernstein was independent, so we weren't really pushed by the company to necessarily always have buy ratings. And so you saw a lot of the other banks, the bias was always to convince somebody to buy the stock. We were one of the few people who would actually say, we have a sell recommendation on something. Sometimes the company wouldn't like that, but that was the independent research that we did. And so it was just a really fortunate place to be at that moment to start your career, where you can really sharpen those skills.
So it started there, and it's not an obvious leap to AIM, which is Invesco today, which actually helped put Houston on the map financially, really. But they're truly an opposite momentum growth shop. So how did that happen?
Yes, so I had always, so my journey, and take a step back to how a chemical engineer ended up at an investment shop is really a curious thing as well too. And I was a chemical engineer working in a consulting firm, and had the opportunity through somebody who was there to leave that role and become an analyst at Bernstein. But in that period, I was also trying to understand, like, what's going to be my path? Because as a chemical engineer, I wasn't sure, did I really want to just continue to be a chemical engineer or do something different? And I was in a bookstore, and I like to read a lot, and I happened upon this book, and I flipped the back of it, and I noticed the person had gone to my college, and he was an investor, and it was a really interesting story. So I decided to read the book, and I didn't know who he was, and this will make many people laugh when I tell you who the book was, but it was about Warren Buffett, and it was Roger Lowenstein's The Making of an American Capitalist. And I read the book, and I was hooked. I was hooked with the person. I was hooked with the story of how he thought about investing. But I also was hooked upon this idea of being a lifelong learner and about really always trying to explore and be curious all the time, which just fit my natural tendency. And so when the opportunity came to make the shift from Bernstein to AIM, AIM, as you know, was thought very differently than the way Bernstein approached investing. But that was something I wanted to explore and to understand better, to become a better investor. If I was going down this path, you have to learn every piece. And I think that's sort of the skill that all investors should strive for, is to look beyond whatever your bias might be, to say maybe there's a different way, and maybe I need to be looking at that way too.
So that really opened your eyes to wanting a new opportunity, a different opportunity at AIM, now Invesco. What lessons or what takeaways were there from your experience at AIM Invesco?
Yes, so AIM taught, what the biggest lesson was the fact that investors often underappreciate positive momentum. And I think that's something for value investors is sort of the opposite, where a lot of value investors say that investors are being too exuberant, so the price is too high. But at AIM, the thought was, if the momentum of the business is strong, then the stock having strong price momentum may be underpriced, and you should continue to purchase those if the momentum continues to be strong until it doesn't. And so I think that was something that was a real revelation to really watch in practice actually happen, because there's a behavioral component to that as well, is that when investors see something going up, they tend to buy a little bit more of it. They feel this positive feedback loop. And so to understand that that's one aspect of the way that stocks might move, it was something that really was a great learning moment for me. And on top of it, I actually was there in the sort of the 2000 to 2002 period. So if you remember, that was when the tech bubble had just burst. Most of the momentum stocks were within the tech industry. So I was fortunate, again, I use that word fortunate a lot. I was lucky to work for somebody who realized that you didn't have to just stay in a sector. And I think a lot of investors at the time said, if you're investing in momentum, you have to be in tech. And he said, no, let's explore. Let's look around and see where can we find other places that have similar characteristics. And we actually, early in the 2000s, started looking at housing. And as you know, that was the beginning of something that eventually turned into another bubble 7 or 8 years later. But at the beginning stages, they were very undervalued companies with very strong momentum, growing very fast. And this was the big lesson coming out of AIM, is always look for those new opportunities in places that maybe you didn't think that you might find them.
And the Sanford Bernstein experience of looking for true value informed those decisions too. That's an interesting
Absolutely.
dynamic.
I mean, I remember like looking at some of those housing stocks. They were true value stocks because you would sometimes see them at 5 or 6 times earnings, which is ultra cheap, which is a very Bernstein-like investment. But then they were growing at, let's say, 20 to 25% a year. That's very growth. So to get that combination was just the perfect sort of storm of, this is exactly what we're always looking for, is finding those places where there's opportunity that combines both.
Were there mentors or people that you learned from at AIM that you want to talk about?
Yeah, I mean, I think one of the biggest influences on me, and even after AIM, and we've stayed in touch, is Joel Dauberpool, who was the portfolio manager of the AIM Value Fund at the time. Mm-hmm. And Joel was one of those people who had that sort of foresight to understand, like, how do these things, you have to look outside of where you might be comfortable and also have conviction. And I think that's the biggest lesson I think I learned from Joel was if you believed it, make a big bet and stick with the bet. And if something changes, be willing to change and flip the other way.
Be resilient.
Be resilient both ways. So be resilient to say, I can hold this stock the whole way up, but if something's changed in the information, I can sell this too, and I can go to the next idea and the next best idea. That's a really unique skill to have, and an important skill to remember that, sometimes we get wedded to investments, right? You say, I've done so much work. I really love this company. I really love this, bond that I bought. I really love this alternative private equity investment I made. But the understanding that maybe things have changed. Maybe there is something changing. Maybe there is a shift. We need to pivot. And that ability to pivot is something that I always attribute to that experience with working with Joel.
Well, and it's interesting that you thought that Warren Buffett also had that ability to see around corners. And it sounds like Joel did too, yeah. In a different vein. So very, very interesting. So then after AIM Invesco, you went to Mockingbird. And Mockingbird, long short hedge fund. And it became part of a family office. And so you spent time working in a family office as well. Can you tell us about that?
Yeah, so I decided that, and I'd always wanted to I had a little bit of an entrepreneurial bent in my mind and always a little independent too. And so I wanted to start my own firm. So I left AIM and said, let's start Mockingbird. And Mockingbird, I picked that name from all of you folks in Texas. It's, of course, the state bird of Texas. But there's a second reason, is that the mockingbird is actually known to be a defender of the nest, like a very fierce defender of the nest. And I wanted my investors to know that that was step one, is that we're here to protect your assets. Step two is to make those assets grow. But risk was really important always to me as an investor, that we should never deviate from this idea that the first thing, there's the old rule of, rule one is don't lose money, and rule two is never forget rule one, right? And I think that was something that I really wanted to stress to my investors. And so we started out as just a long-short equity hedge fund. We evolved a little bit and started to invest in some privates and some things within the hedge fund. And then 2008 happened, and going into 2008, we had started to see some cracks in the mortgage market in California particularly. And we didn't really understand some of the valuations of some of the banks there. And so we were starting to short those banks very painfully in the early days in 04, 05, 06. And then 07, the news started to come out that there was some really bigger issues in the financial markets. And in 08, we actually did okay. We managed through that better than I think many of our other peers. And so the family that became, over the years, my largest investor in the fund asked, would you like to come and start a family office for us and help run all of our assets? And so we effectively turned Mockingbird into their family office. And that opened up a whole nother world for me, because primarily I was investing in equities and to some level fixed income. Here we could invest in anything. So I had an open door to look at other funds, private deals, private credit, uh, alternatives, quantitative funds. We looked at all of it, and so started to learn this idea of how to allocate across multiple asset classes. And this was really that first step into true asset allocation, where I really started to get deeper into how do you think about putting together all these assets to get an outcome that was non-correlated to other things. And so that word became something new or newer to me of we really have to find lower correlation in the set of assets that you put into a portfolio to reduce the risk, to reduce the volatility, but not sacrifice return.
So, one of the things that we have in common, and we talked about what your approach to risk management is, because it's front and center with you and always has been. Can you talk about your approach to risk management today?
Yeah, so I think the first thing I always like to think about when you think about risk is permanent loss of capital, right? So your first step is, can I lose all my money in this investment, right? And there are, I go back to the example of Fannie Mae and Freddie Mac in the financial crisis in 2008, and I remember there were a lot of investors who were making the bet that the likelihood of them going to zero as investments was zero because they were a government entity, right? They were effectively a government organization. And because you had started to see some of these failures happening, particularly within the government, I started to think, well, there's a non-zero possibility that the equity of Fannie and Freddie could go to zero. So I said, why do I want to take this risk? I don't have to. There's thousands of other investments I can make that have similar risk reward characteristics, but don't have that risk. So I think step one is that belief in permanent loss of capital. The other is to really take a strong look at diversification and how you diversify. So I think the initial thought is you just diversify by throwing a lot of assets together. And that's fine if they don't all move together. And sometimes what we find is a lot of times you'll have these portfolios of assets where all of the assets move either with the economy or they move with interest rates or they move with the direction of inflation. So you're really not getting the true hedge that you thought you might. And that goes across asset class. So sometimes you might own a stock and a bond and both of them are moving together. Well, then your thought that if I allocate 60-40 between stocks and bonds, I'm going to get hedged out may or may not work all the time. So you have to really take a purposeful approach to diversification where you're understanding what is the outcome I'm trying to get and think about how to use each asset class or each strategy to be able to achieve whatever my goal is at the end, which is usually, and for all investors, really, I think there's three things that they're looking for is protection, appreciation, and income. And where do I want my mix to fit on those three planes?
In an environment where you perceive risk, what is one thing you can look at with respect to different managers and different investment funds to determine whether or not they're managing risk?
Yeah, I think the biggest one, and I know we've shared this conversation many times, is to, when you're evaluating managers, is to see how they've performed in those difficult markets and various different markets, right? So you've had, ultimately there are really three ways that markets can show stress. One is through inflation causing stress, one is a liquidity problem, and one is falling growth or a recession. And so if they've been able to operate in all of those three and find ways to manage at a better risk-adjusted way so their returns stay relatively steady, they have less downside in those periods, and they're prepared to capture the upside on the other side, I think that's a real key for me to watch these managers' performance in these down markets. And I think that's why this is a particularly interesting moment in the investing time is there's a lot of managers that haven't really seen a downturn or when they've seen the downturn, they really haven't been sure what to do because the world has changed in a way that they didn't expect. A lot of people haven't seen inflation in a long time. Uh, Really understanding what to do when there's a liquidity event where you have tightening yields. These are things where experience really matters. Experience, and flexibility, which I think those are the two hallmarks of a great manager, is that they really have understood how to manage through a lot of different periods, and they're willing to be flexible in their thinking. And again, that going back to being the learning machines, and finding those managers that when you have those conversations with them or you do your due diligence of them, you really believe that they have done their work, and you can evaluate that in various ways, either quantitatively or qualitatively.
You spent time at Mockingbird, which became a family office. What made you leave the family office world?
Yeah, it was interesting. Towards the end of my stint at the family office, I had this sort of my own realization that I missed having clients. I missed having impact on a wider array of investors. And so I actually left the office voluntarily, which many people say that's family office roles are typically those types of roles where you stay for a very long time. Very difficult to get because you have to build the trust with the family, and you work with them for a long time. But I went to them and said, I really want to widen my scope again, and they understood. And I initially went to a firm called MBM, which eventually got bought out by BOK Financial, which managed money for individual clients or high net worth individual clients, and also helped advise for their 401k participants on how they should invest. And so this felt a lot more in line with the path I wanted to go on to have a wider impact. And it also helped in understanding this notion that you can create portfolios for individuals that look like institutional portfolios. And that's what we really did during that time, is build portfolios that achieved a lot of these different types of goals that were institutional-like, but using very traditional liquid assets. So that was the opportunity there. So MBM really was that transition and the bridge from the single family to the wider array of investors.
Okay, great. And your most recent position was in the Franklin Templeton Institute, and essentially you were part of a team that led global strategies.
Yeah.
Tell us more about that.
So as the MBM eventually was bought by a bank, and the bank had sort of a different approach to the way that they were managing money. And so I had this opportunity to shift to Franklin, which again now broadens even further, broadens globally. And so now I have a opportunity to again expand my knowledge, because I can look at the world from a local perspective through all these different offices and managers and analysts that were there, because the Institute had a real central role across the organization to try to be a thought leader across all of the managers. So we really pulled a lot of the best thinking of a lot of the managers there, synthesized and thought about really what's the world look like, and how should we be investing. It was really, again, I was very lucky to join a team where we had teammates from India, from Singapore, from Poznan, from Scotland, and then of course some based in the US. So having this really, really wide team, we really knew what was happening around the world. We really knew what the clients were thinking around the world. So you could get a real sense of how do you put together a portfolio that works. And actually the really fascinating thing that happened too during this time was, Franklin is a very active manager, which as we've talked about, active management is something we think is going to be much more important going forward than it really has been over the last 10 years, where we've seen passive strategies outperform active strategies for an extended period. And so it was really interesting to watch how Franklin navigated that, because that was it's a difficult time to convince your investors that we are performing well, but we're not performing well relative to the index. We're performing well on a risk-adjusted basis. And really communicating that to clients to hold them, to make sure they understand, yes, you may feel like for a couple of years here you're losing a percentage point or two each year, but when things get a little more challenging, this is where you're going to really appreciate the risk management. And I think that's something that was something that I really appreciated from the experience there.
Well, because now you've got a very rich quilt of both being on the front lines as a U.S. only investor, primarily with Sanford Bernstein, and then AIM stretched out a little bit, and Franklin Templeton took you to a whole nother level globally.
That's right. No, I mean, and that really has been, what led us here, because I think that once we got to this place where, the markets keep going up in this really, really sort of vertical path, and then we had these two dislocations, right, in the last few years. One was, of course, COVID-19, and the other was 2022. And I think what both of them gave us a little bit of a lesson in is COVID was a shock that the world did not expect in any way, which did two things. One is it stopped the supply chains of products around the world, and it stopped consumer spending because we were all at home. And those two things highlighted that we're very interconnected as a world, and more so than maybe we thought. And so it's created this idea that maybe we need to be less connected. Maybe we need to rethink globalization. So that's a big shift, because the world has been globalizing for the past 40 years, almost continuously, pretty much since post-World War II period. But then you get to 2022, and 2022 was a period where we tightened financial conditions for the first time in a long time in a significant way. And the markets reacted with taking down all assets, right? It wasn't just stocks, it wasn't just bonds, it wasn't just alternatives, it was everything. And so that then made investors have to think, how do I manage my risk if something like this could happen in terms of a liquidity issue, where you're tightening financial conditions, where we're used to very, very low interest rates and have been for a long time. Now we're tilting the other way. So you have these two factors that now are just a part of the reality going forward, that I think is going to be very important for investors to consider risk a lot more than they have had to think about it over the last 15 years, particularly post 2008. In the 2008 period, there was a lot of government support, particularly out of the U.S., but it was global, of trying to support markets, support economies, and that support may be changing.
You always hesitate to say it's different this time, but we have had a pretty good 16-year run here. And so just looking at it through a new prism might make some sense. So when you think about the experience you've had and arriving at Stavis Wealth, what is it about Stavis Wealth that makes you feel more at home?
So I was, when I met with you the first time, Deborah, and I looked at the approach that you were taking to how to treat the client, that it grabbed me immediately, because I think one of the things that I find interesting within the investment industry is that it's somewhat siloed, where you have investment management, you have insurance solutions, you have asset allocation, you have all these pieces that are not always connected together. Estate planning. These all should be connected, because, for example, and this was something I learned in the family office, is that you need to have an understanding of every family situation, their needs, their wants. And for example, like the family I worked for had a large private business in a specific industry. So that would influence me on the investment side to maybe not have as heavy a weighting in that industry, because there was no reason to get that exposure. this idea of holistically looking at the entire picture was something that really attracted me to what you are trying to build here, and where you saw that the investment management piece should be interconnected with all the other pieces of the client experience. And I think that that was something that I immediately wanted to be a part of, because I saw that you you fully understood that it wasn't just about, is this investment going to go up or down? Is this a stock going up and down, or the economy going this direction or that direction? It's really taking a deep, it's really listening to your clients to make sure that you're understanding what aspects of what you're trying to accomplish for them can be accomplished through the investment side versus other aspects of the financial journey.
A deeply integrated approach was what attracted you, and the deep connection that we can make with clients and the impact
That's
on
right.
their lives. So, following such vast experience, you and I took a lot of time talking about why Stavis Wealth might be the great next and last stop. Tell me about what it was that led you to a decision to join us as a leader at Stavis Wealth.
No, and I really appreciate this question, because I think our conversations really cemented for me what my suspicion was when I first sort of started talking to you about the opportunity. Was the breadth of the offering at Stavis is estate planning, it's insurance, it's the client experience. And adding investment management was not part of this idea of it's just a separate siloed part of this experience. It's a part of the whole. It's this holistic, the holistic approach to how a client should feel about their financial condition. And I think that that's something that's really, really important, that is sometimes it's not something that's done a lot within our industry. I think that often you do silo each piece of it, but you don't connect them. There's not the, if I have a business that's in a specific industry, why wouldn't you make sure that the investment management side understands that, so that they don't overexpose you to a certain sector and create more risk for the family? And so I think that integrated approach that you sort of are trying to achieve, it was really appealed to me, and I really thought that was the reason that it really put me over the top of wanting to join the team.
As Chief Investment Officer, how do you view your role in terms of investment decision making?
Yeah, the way I approach this is, I think first step is identification of the best investment ideas. And that may be best funds, it might be best stocks, it might be best bonds, maybe just individual, here are the best in class. And that best in class has a different component than I think most other investors use, which I very much use downside deviation, or how investments perform in down markets or down economies. And that's a key part of the decision-making process. So, a lot of times when you see screens for, I want to own XYZ fund, the screen will talk to you about their great 10-year track record, but it doesn't always incorporate, or often incorporate, how did they do when those breaks happened, even in that 10-year period. Did they protect assets well in that period? And so that's a really key part of the decision-making process for developing what funds or investments to use. The second step is trying to figure out how to put those together in the most appropriate way. And the approach really is to start from, what's the goal? What's the goal in terms of returns, in terms of income, in terms of the volatility that the client is ready for, and what are the right assets you put together to meet those goals. And they might be in a traditional format. They might look like the 60-40, but often they're not going to be, because in different conditions or different periods of the market, you might use different asset classes in different ways. There were periods of time in the last 15 years where dividends from stocks were a better way to get income than very low yields from bonds. And you were actually getting appreciation from bonds and income from stocks, which was really the opposite of what most investors think. So I think that there is this approach that you have to take of that we'll be taking and that I will continue to take is make sure you put the right assets together for the conditions that you see today to get to the outcome that you need.
And even customized to that client.
And that's exactly right. And then I think that last step is really key, is customizing it to the client and to the client's entire situation. So understanding how much how much they have in their home, how much they have in their insurance plan, what does their estate look like, what is their goal for giving to their children, what is their goal for giving to charity. All of these things have to be a part of the decision of, so what should that portfolio look like. So that's where I think that's the difference in what we do versus what other managers might do, is that you might just say, here's the model, this model is going to get you somewhere, but the model is inflexible a lot of the time, and it's really hard to just stick with a very, very inflexible model when you have unique goals and unique objectives for every client.
Great, thank you. As Chief Investment Officer at Stavis Wealth, how do you view your leadership role?
This is that was, I think, the other attraction of being here. We're small, we're nimble, and we're willing to be flexible. And I think that as a leader, I like to be very collaborative. I like to make sure that everybody's views are taken into account, because there are gaps in all of our knowledge. We all know that. And so to be able to put those gaps together and figure out exactly how do we solve these problems together is the approach I like to take as a leader. And I think that being able to help shape the path of what we do is really, really attractive to me. And so that was one of the big reasons for wanting to be a part of, especially at the early stages of the firm, where we're really, we can build it the way we want to build it. And I think, our conversations have led me to this conclusion that you have, a really open field that you're thinking about. And that's the way I approach this as well, is I think there's an open field of how to do this the best way, and not have to follow any sort of the preconceived conditions that most of the other investment management groups have to follow, because a lot of times there's limitations on what they can do.
Yeah,
I don't think we have any limitations here.
We're, as you said, we're small, nimble, we can pivot, and we can customize. And there's not as much customization as there used to be, perhaps. And I think it's an opportunity as the winds of investments change. And you simply fit perfectly into the firm's philosophy. And, the fact that we can combine our skills in an integrated, holistic planning, investment management, estate, and insurance solution is really refreshing, Samir. So I cordially welcome you. And I'd also, one last thing, I'd like to know what you do outside of work. I know you're deeply rooted in the Houston community. Can you tell us about some of those experiences?
Yeah, Houston's my home, and one of the things at Franklin that's interesting is I've been working remote for Franklin for the last 7 years, because I didn't want to leave my home, and they were open to that because they knew how important Houston was to me. Families here, my families are deeply rooted here as well.
Their home office is not in Houston, right?
Yeah, Franklin is not based here, and they don't have any offices here. So I was working from my home and just traveling there periodically. So, but we've been, as a family, my family and I, we've had a lot of commitments to organizations within the community that are important to us. Giving is very important to our family, and across a lot of different dimensions. I'm always hesitant to say which, because there's a broad array of places we like to give our time or efforts in giving back to this community that's given us so much as well. I'm as I said, I'm a huge Houston sports fan. I've been since, painfully at sometimes for many years.
But loyal.
But loyal. I tell a story. I've been a season ticket holder of the Houston Astros since 2000 with a group. And we had a period, as many of you know, where the Astros were not doing very well, and the 14-15 era. And so half of the group wanted to leave. And I said, no, we can't let this group fall apart. So I recruited a bunch of friends and said, hey, can you join our group? Please join our group. So I ended up getting 5 different friends to come into the group. And I said, I promise someday they're going to be better. I don't know when, but someday they're going to be better. Little did I know what happened over the last.
What a reward!
What a great reward!
What a reward for that patience!
But that's and that goes back to the patience, right? And to patience and belief. And I think you can translate it into the joy of watching sports, but it translates very well to investing, right? And to what we're trying to do for families and what we're trying to do in terms of really making sure that our clients are protected and will be able to live the lives that they want to live because they'll have the financial wherewithal to be able to do that.
And we shared the fact that both of us have an interest in eliminating food deserts in Houston. And we approach it from different organizations, but all with the same goal.
Yes. That is we've spent a lot of time with the Houston Food Bank as a family.
And we with Target Hunger.
And I know you with Target Hunger as well. And so I think it's the first thing that we need to make sure that everyone has enough food to eat. I mean, that should be a fundamental.
Even on Maslow's hierarchy of needs, it begins there,
it
right?
Has to begin
food
there.
And shelter.
That's right.
And so we are so excited for you to be part of the team, to help lead the team. And while we were careful and we took time to make this decision, both of us, it's going to be great. So welcome.
Thank you so much, Deborah, and thank you very much again. I'm very excited. I'm ready to get to work. Let's make this happen.
Great. Thank you, Samir.
Thank you.